In this video, we're discussing pooled investments, so primarily funds with a focus on mutual funds. Mutual funds are obviously the alternative to trying to construct a portfolio on your own as an investor. If you invest in a mutual fund, then you and other investors, so each investor has a proportionate or pro rata claim on the value, but also the income from the fund. Obviously the value of the fund and the income from it, and by the way, the value of a fund at any point in time is typically referred to as its NAV, or net asset value. Assets of the fund minus any liabilities. Liabilities could, for example, come about from the fact that certain funds have expenses which remain unpaid, so they've got payables, but it also could come about from things like obligations to buy back shares or stocks or securities when they engage in short selling agreements. Right, I've drawn two arrows here because I want to talk about the most typical mutual fund structures. These are open-end and closed-end funds. Now, closed-end funds, although they are a distinct category, they are nevertheless much less important in terms of their size in the investment industry. But we'll discuss both. Right, so the way an open-end fund works is that it absolutely accepts new investments or new investment money, right? And whenever you want to invest additional money into the fund, that fund issues new shares. At the same time, the fund also allows you, that's the investor, to withdraw your money, so money can also be withdrawn at any time. Well, not necessarily at any time, but with most of the funds available to the general public at any time. Money can be also, withdrawn, although with some funds that withdrawal is only possible on specific dates. Now, the important thing is that both the new investments and the issue of new shares, as well as the withdrawal of money, happens at current NAV, whatever net asset value is, NAV per share basis, over here and over here. So what does that mean? Where let's draw the fund over here. If that's an investor wishing to invest, the fund will issue shares for that investor, but the amount the investor has to put in will be based on a current appraisal of what's in the fund, the value of the fund, that's its net asset value, NAV, which is typically calculated, for the big funds once a day. So you'll have to pay an amount equal to the current NAV per share at the time when you're making the investment. On the other hand, if you're an investor trying to withdraw your shares, let's say sometime later, you'll give your shares back to the fund, and for redemption, and the fund will pay you out an amount equal to the current NAV per share. Now, of course, the two are not the same. Everything is based on the conditions at that given moment in time. So you transact with the fund, the number of shares which the fund has in issue, number of shares outstanding, therefore fluctuates, changes over time. The other structure, that's the closed-end fund, works very differently. After the initial issuance of shares, the fund does not accept new investments, so new money from investors, and therefore the number of shares outstanding does not change subsequent to the initial issue of shares. So the way this would work would be very much like you would have a company doing an IPO, initial public offering of shares. So the fund issues a certain block of shares, investors buy these things, pay money into the fund, and now the fund obviously uses that money to make investments. But subsequent to this, the people who already held the shares, they cannot go back to the fund and ask for those shares to be redeemed. The only thing they can do is potentially trade with other investors. So the shares of closed-end funds will typically be tradable in the secondary market. These shares are traded in some form of secondary market. The trouble is, over here you've got the fund making its investments, and at any point in time on any day you could calculate the NAV, the net asset value of those investments, on a per share basis. Obviously on a per share meaning divided by the number of shares the fund has issued. And over here, the price at which these shares trade, the shares of the fund, that price, share price, will not always be equal to NAV. In fact, it will a lot of the time be quite distant to it, either trading at a discount or premium to the NAV. And that's something you'll find with closed-end funds. It's kind of their inherent feature. Now, there are both advantages and disadvantages of the two sort of structures to organize funds. The open-end fund, well, the great or huge advantage of it is that it's going to be easy for such a fund to grow in size. And of course, growing a fund in size means it's easy for it to have more and more assets under management on which it charges management fees. Good news for the manager. However, the problem with this construction is that the manager is not really in control of everything. They don't control the size and timing of inflows and outflows into and out of the fund. So when lots of clients, let's say, want to withdraw their money, the fund manager will be forced to liquidate investments, sell assets, which they may not think is a good time to, precisely now to sell those things. When lots of money is pouring into the fund, the manager is forced to find ways to invest that money, although that may not necessarily be the best moment to buy assets in the market. And this is where some of the discussions we typically have in quantitative methods around ways of measuring returns. You will for sure recall our discussions on money-weighted and time-weighted rates of return. I often stress there that if the manager is not in full control over the size and timing of cash inflows and outflows into and out of the fund, it's better to assess them on a TWR, time-weighted rate of return basis, rather than money-weighted rate of return. This is precisely the same argument. Now, of course, what is positive here can be turned easily into a negative on the other side. A closed-end fund, once it's sold its shares, has a restricted ability to grow. So these funds never really become that big. But, we don't have the same problem as over here. The manager, sorry, that was supposed to be not a small plus, it's a big plus. The manager has full discretion. The manager is in full control of everything, and they can just get on with the business of implementing their investment strategy. Obviously, whether that strategy is successful or not is another story. Right, another split that you may be asked about is the split into load and so-called no-load funds, right? If a fund is described as being loaded or a load fund, it means that in addition to your classic management fee, the investor is also charged. So investor is also charged for, and that charge is the load for investing, for the pure action of investing. So when they purchase units or shares of that fund, but also for redemptions often, when they want to withdraw the money, right? And this load is typically collected, or the charge is typically collected by the brokers who are intermediaries between the retail client and the fund, and part of that charge, part of that load goes towards compensating the brokers themselves. However, it's important to note that the relative importance of load funds is becoming smaller and smaller, and more funds these days are of the no load nature, meaning there is no additional fee, no additional charge for investing or redeeming money or for redemptions. So just the classic management fee, therefore. Okay, good. Now, the next sort of point when we talk about different fund structures is to discuss mutual fund types, but this time making the split according to the types of assets that these funds hold. So this is the split by asset class. And we're going to start off with the sort of most conservative, safer funds, that's money market funds. So these will be the types of funds that invest in short-term money market instruments. If you've studied fixed income already, you will know that money market instruments are short-term securities with a short time to maturity. Typically, your book says they'll hold stuff that matures even as quick as overnight, so tomorrow, or maybe maximum of 90 days. In theory, the money market is everything between maturing tomorrow and maturing within 1 year's time, but very often they focus on the shorter end of this. So typical instruments held would be things like treasury bills, short-term securities issued by governments, commercial paper issued by companies, certificates of deposit. Now, the aim of these money market funds is not to grow in value, it's to make sure the principal, the capital provided by the investor is secure. So security of the principal, the amounts invested. Also liquidity is a big priority here, and they try to provide a return that's generally equal to whatever is the money market rate, close to typically what one could get at the central bank. Now, of a more technical nature, you could get a question on two abbreviations. These money market funds may operate under one of two possible bases. One is CNAV, the other is VNAV. VNAV, of course, NAV here stands for net asset value. The C is constant, whereas V would be variable. And what does that mean? Under a CNAV basis, so this under CNAV basis or a VNAV basis. The first one means that the share price, the fund issues shares which investors buy, but the share price here stays constant, let's say, e.g. at $1 or €1, whatever. Here, the share price may change, may vary. Now, the way the CNAV the share price would stay constant at $1, even though the fund is generating a return, is that if that return gets completely paid out to investors, so we constantly go back to holding the symbolic proverbial one if you distribute all the income being earned to investors. Right, so that's the first type of fund, money market funds. The next one, although your book doesn't say anything really meaningful about these, is bond market funds. I mean, you should by now probably know a bit about bonds. I'm assuming you may have had an opportunity to study fixed income to some extent. So these are funds which hold bonds, government, corporate, and there are specialist funds holding only treasury or only corporate bonds. But interestingly, possibly they could also have in their portfolio preferred shares, which even though they are shares, so equity securities, they behave in a nature that is very similar to fixed income instruments because typically of their stable dividend. Now, the next one is stock mutual funds, so funds investing in shares, stocks. And here your book, once again, sort of talks about the split into actively managed funds, so actively managed. Sorry, let me write that properly. Managed, and those funds that are passively managed. And we've kind of discussed this already, but, you know, they make a nice kind of comparison of the two approaches, so I'm going to follow with that as well, and they do actually make some points which were not made in previous videos either. Remember that the goal of a manager performing active management is to outperform. The goal is outperformance, typically relative to a chosen benchmark, whereas if you're passively managing a fund, your goal is replication. You want to replicate the performance or typically of an index, a benchmark, right? Like the FTSE 100, the DAX in Germany, or the S&P 500 in the United States. Given the sort of more ambitious goal over here, you're going to have higher management fees in the case of actively managed funds, and definitely lower management fees over here on the passive management side. And that higher management fee can be justified, for example, by the fact that in order to achieve this outperformance, the manager has to pay for, let's say, research, right? Perform research, a lot more work than just passively replicating an index. Also, as a consequence, you're going to see higher levels of trading or higher volumes of trading. There'll be more buying and selling of assets into and out of the portfolio and less trading over there, which obviously also gives rise to transaction costs, higher transaction costs on the actively managed and lower transaction costs on the passively managed side. Now, an important point, which is not so easy to appreciate, but sort of at first hand, in some jurisdictions, a fund may be forced by regulation to distribute realized capital gains to investors. So if you bought shares for this price, but you subsequently sell them for a higher price, that is a capital gain which has been realized, and that's subject to taxation. So if funds are forced to distribute realized capital gains, obviously distribute means pay them out to investors. What will happen is, because they trade a lot more, there is a lot more on at least the actively managed funds, they trade in and out more. There are more opportunities to say, oh, that's a capital gain which has been realized. So there will be more opportunities for them to be, for those gains to be taxes. They are typically associated with higher levels of taxes, whereas here on the passively managed side, you just buy stocks and you typically hold them for a much longer period of time because your portfolio doesn't change and rotate so much. So there are gains indeed from the increase in price, but because you're still holding the shares in that passively managed fund, or the fund is holding the stocks long term, those gains are not realized. Hence, definitely lower taxes being associated with this strategy. And let's also mention that there are the so-called hybrid or balanced funds. These are the ones that invest in a mix of typically stocks and bonds. So they don't confine themselves to one security. Your book says that they are more popular in Europe than in the United States. And let's just mention one specific example of this, lifecycle, so-called lifecycle funds. And these dynamically adjust or change their asset composition, change the asset mix, based on some target retirement date. So a fund, this is typically, designed to attract people who want to retire at a specific point in time. And the further we are from that target retirement date, typically the more shares you'll hold, the portfolio will hold. And the proportion of bonds, the safer instrument, will be lower. But as time flies by, the proportion of shares in the portfolio will get smaller, and the proportion of bonds will increase to reflect that as you get closer to retirement, you probably want a more conservative portfolio so as not to endanger its value too much. Okay, I think life cycle funds is a good one to know potentially for a theoretical question. Now you have to also be aware of sort of other investment products than the classic mutual funds that we discussed already. Just alternatives, and a lot of this is stuff that we've already discussed, or you have an opportunity to watch videos on in the alternative investments section of the curriculum, because we discussed a lot of these quite specifically there. First of all, SMAs, or separately managed accounts. By the way, these can function under various names. They're also known as, instead of separately, they'll be called individually managed accounts. They can be called simply a managed account. They can be known as a wrap account. So different versions of this exist. But it's like a fund which is managed for a single client, or an account that is investment account managed for a single individual client. This will typically be an institutional client or a wealthy individual. Now, unlike with mutual funds, where the funds are owned by the fund and investors have shares of the fund, here the assets into which we invest are owned directly by the client. Directly by the client. And this is something I remember also covering when we did alternative investments, or when recording the video on alternative investments. Typically they're associated with a relatively high minimum investment. So the client needs to put in quite a lot of money to qualify for this sort of individual treatment, but it does absolutely, the whole point is that it allows for an investment strategy that's going to be sort of well tailored to the investor's circumstances, as opposed to a one-size-fits-all with general mutual fund. Right, don't need to know much more about this. The second one is ETFs, which over here just get mentioned very briefly without going into too much detail, and I won't go into too much detail either. But ETFs are exchange-traded funds. So as the name suggests, they trade on exchanges, their shares trade on exchanges, and that makes them very unique, because if something trades on an exchange, it can be traded on an intraday basis, meaning you buy one moment and you sell a few minutes later, a few hours later on the same day, and they can also be used for shorting, just like any other security trading on the market. And this makes them very different to open-end funds. So let me say, unlike open-end funds, you can't take the shares of an open-end fund and trade them intraday. Why? Because all the transactions that you do on the shares of an open-end fund on a given day are ultimately priced and transacted at the NAV, net asset value of that fund, from the end of the day. So even if in the morning, you buy some shares and then you try to sell them back to the fund in the afternoon, you'll transact at the same price, which doesn't really make sense from the point of view of an investment strategy. With something that continuously trades on an exchange, you get the possibility of price movements intraday, and therefore the possibility to make money this way, right? Now, very importantly, the market price of an ETF share will track very closely, typically, the NAV per share of the fund, which, as you may remember, was the problem with closed-end funds. Closed-end funds have shares that typically do not trade at a price equal to their NAV, but that's because closed-end funds don't have the ability to issue additional shares or redeem shares. ETF shares are subject, or the number of ETF shares is subject to fluctuation. What else? Your book mentions, at least in this topic, there are more topics where we talk about ETFs, and there are other features, and also the mechanics. ETFs typically pay their dividends out to investors. What do we mean by that? Because ETFs have shares, they invest in shares typically, not just shares, also dividends. But if they hold shares, they will be from time to time, receiving dividends on those shares. And ETFs typically pay those dividends out as cash flows to investors. Open-end funds, on the other hand, don't. Open-end funds typically reinvest the dividends which they receive. Okay, that's also a feature which you may be asked on. And ETFs, definitely, your book says, typically have smaller, lower minimum investment amounts. Investment sort of requirements smaller than would be the case with open-end. Although, that is very fund specific, it may be the case in general, but not always the case. That's the message. Okay, the next category, now, this is something we've already discussed in previous videos, so hedge funds. A lot of you know a lot about hedge funds by now. What's so special about hedge funds? Well, they typically use... It's very difficult to define what a hedge fund is because hedge funds can vary, but they typically use leverage, they typically use derivatives in their investing, and they adopt both long and short positions. So let's take these features and add a few more. First of all, short positions. This is obviously positions in financial markets which gain if the price of something goes up. This can be done directly via short selling, where you borrow securities and sell them in the market, and when the price drops, you have to buy them back and return them to the original owner. Or you can do it via derivatives, which is synthetic. And we talk about it in the derivatives section of the curriculum. Unlike your classic open-end or closed-end funds, mutual funds, hedge funds typically seek absolute returns. So they don't try to outperform a chosen benchmark. They simply try to deliver returns in an absolute sense. They try to, for example, always deliver positive returns of at least so and so much, not more than an index, because if an index is falling, more than an index may mean the fund falls less, the fund value, the fund NAV falls less than the index. Leverage, right? This is either achieved via borrowing or via derivatives, but basically derivatives, it means that we are playing in hedge funds on a scale bigger than the size of the investment that we've got from our capital investors. They typically have low correlations with traditional assets like bonds and equities, and they've got a very specific fee structure. Now, you can learn all about this by watching the alternative investments video. You'll know that hedge funds typically have both a management fee as well as a performance or incentive fee built in, and that incentive fee can be quite high, for example, 20%. And very importantly, they're not available to everyone. They're not available to all investors, absolutely no. Typically, they only accept money from investors who can meet a pretty demanding minimum investment requirement, and they have liquidity restrictions. It's not so easy to take money out of a hedge fund. You will be asked, well, there will be typically a lockup period, and then even once the lockup period is over, you'll have to provide adequate notice of your intention to withdraw money. Now, the final category is private equity, PE, and VC. Sorry, this was supposed to be a C. VC or venture capital funds. PE and VC funds, private equity and venture capital, once again, a big category within alternative investments. What these funds do is they buy companies or shares in companies, but pretty big, hefty stakes in companies, not your 2-3%, very often majority stakes in companies. They buy them, they try to restructure them or optimize them, and subsequently sell their stakes in those companies. And we call those companies portfolio companies. They could be sort of more mature businesses, in which case we talk about private equity. They could be startups, which don't necessarily need optimization, but they need nurturing to grow into valuable businesses. When the sales are made, we call these exits, or this happens at what's known as the harvesting stage of the life cycle. Unlike with mutual funds, where typically the fund manager is just a passive investor buying shares hoping their price will go up, the managers within private equity and VC definitely adopt more of what would be described as a hands-on approach. They get involved in the day-to-day running of the business. They typically want to appoint key managers in the business so as to make sure the business is being run, or those portfolio companies are being run in accordance with their expectations, and they want to also be in control of what's going on. The lifespan of such a fund, of these funds, is typically somewhere between 7 to 10 years, although, of course, that's just average. And some important features that are worth mentioning is that the funds are typically structured as partnerships. This is often to do with taxation issues and legal issues. There are two types of partners: LPs, who are the investors who provide the money. LP stands for limited partners, and the GP is the general partner who kind of manages the fund or can manage the fund. That's typically the role taken by the management company. What else? Yes, another distinct feature is that the management fee over here is charged on something called committed capital. So when you find investors who want to participate in such a fund, you typically don't ask them for the money straight away. First, you ask them to make a commitment, so a declaration sort of how much money they are willing to give you. And then you go, and once you have enough commitments from enough investors, you can actually start doing the actual buying of companies, of portfolio companies into the fund. Now, this buying of companies may take quite a long time because you're buying pretty big stakes in companies, so these require a lot of negotiations, and they are typically private companies, meaning companies not listed on any stock exchange. So you have to go to the current owners of these businesses and convince them to, to get you on board, to accept you on board. So until you're ready to make a purchase and actually pay for a company, your investors have only committed capital, and they'll give you the money once it is actually needed. But they already are paying a management fee based on their commitments. So from the moment they've committed, they start paying a management fee, because in that time you as the manager are doing, looking for the companies, doing a lot of hard work, a lot of research, due diligence, etc. And that's work for which you should be compensated. And this is unique because in other types of funds, you'll typically start paying a fee, management fee, once you've given money into the fund, once you've invested, not in the world of PE and VC. Right, and the final point I want to make is a unique feature called carried interest. This is the name by which typically we have the performance fee or incentive fee especially in private equity, but also in VC, in venture capital. Carried interest is the managers, so the general partners typically the manager, that's the GP's, general partners, share of profits from exits. So when we make exits, when we sell companies in which we were invested, typically those exits are made at a profit, and that profit is shared between the limited partners, the providers of capital, the external investors, and the GP, the manager. Very often the manager takes 20% of all the profits made on the exits. That's their performance fee. It's known as carried interest, typically in the world of private equity and venture capital.